Nate, you've got a suite of bond ETFs. You call them longevity income ETFs. Tell me, what do they do and why are they right for investors that might be nervous about the equity markets?
So the key insight is when you buy a bond, you know exactly what you're going to get, the amount and the timing. And when you create a bond ladder, then you don't care about these changes that we're seeing in bond prices because you're going to get what you're going to get. And what we've done in our ETF is we've packaged up that benefit into an ETF that gives you reliable monthly cash flow for the horizon you pick in a simple, low-cost ETF format.
So how does ladder bonds protect from all this chaos? Explain how they work. I mean, I know you can buy them in different maturities. So we've got one going out 10 years, LDDR. You've got one going out 15, 20, 25, 30 years. But looking at the 10-year, I want to show people what you're actually buying here. You own a bond ladder of treasuries going out 10 years. So 6 month, 1 year, 3 year, 5, 7, 10 year. And you get an annual yield of roughly 10% that consists of about 4% yield from the bonds, 6% distribution of principal for the next 10 years. Is that right? Explain how that works.
That's exactly right. What we're really doing is we're trying to create a level monthly payout through the end of 2035. And so we create a bond ladder designed to do that through the way the coupons and the principal come in. And the idea is really to help make it easy to have financial security. If you think you need to spend $50,000 a year for the next 10 years, you can buy 5,000 shares of LDDR and you're going to get that $50,000 divided by 12 in a monthly payment, same amount of money every month, regardless of how bond prices go up or down.
Yeah, and here you see the basic idea here. I mean, this is what's kind of simple about this. You know, Dave, in theory, I could do this at home, right? I could buy a bond ladder of 30-day, 1 year, 2 year notes going out 10 years. I could split this $100,000 equally between all of them. I could collect the interest and then just let the bonds sell off and keep the principal. What I find, and I don't know about you, but nobody ever does that. I don't. It's too difficult.
Well,
for, what is it, 25 basis points, they're doing this for you, right?
You're a little bit wrong. Financial advisors have been building bond ladders for their clients in retirement for decades, and I know some that still do that. This is taking that idea of owning individual treasuries, which you now have to look at, and putting them in a simple wrapper that works more like a target date fund where you can kind of just set it and forget it at a very reasonable fee. Actually buying and selling these large blocks of treasuries isn't exactly fun for most advisors or most individual investors. Being able to do this with a single trade really does smooth that out. And really, you're taking one of the greatest benefits of the US bond, which is that you think it's never going to default, and you're accepting that, right? The only reason that you should be worried about whether or not your treasury is trading above or below par is if you intended to sell it or if you worried somehow it was actually going to go bankrupt. When you use bonds in a bond ladder like this, you're assuming they're never going to go bankrupt. God willing, we're in that world. And second, you're assuming you're never going to sell it, which is the right way to think about bonds as a true fixed income vehicle.
Yeah, and the key point about this here, and look, here's a simple bond ladder. We just put it up here. You could have $100,000 and buy eight bonds, a 30-day bill, a 6-month, a 1 year, a 2 year, a 3 year, and you know, a 7, a 10. There, 5 and 7 to 10. There, you split it up there. They're right there. Buy 100,000, but nobody actually does this, except Dave says some professionals do for their clients. Do you think professionals will be using this, or individuals, or how are you anticipating it?
A mix of both. You know, I'll tell you. You know, we talk to a lot of financial advisors, and like Dave said, some of them do build bond ladders themselves for their clients, but it's a lot of work to go out and buy, you know, 10, 20, 50, 100 bonds, especially if you want to create a monthly income stream. And so most financial advisors actually have a pretty high minimum. And so one of the things that's exciting to us about doing this in an ETF is to really democratize access so that regardless of your wealth level, you can get access to it. And it's not that you need to be, you know, an ultra high net worth individual to get an advisor to do it for you. Everybody can have this, and we can do it in a way that is monthly income, that can have, you know, 10, 20, 30, 40 year horizon, and you can have a choice of whether you want fixed or inflation protected income. And I think that's a broader toolkit than even most financial advisors can offer to their clients today in the absence of this solution.
Yeah, and again, the point is you get an annual distribution of approximately 10%. It depends on where the price of the ETF is, but you're getting approximately 4% from the yield from the bonds, and they're distributing the principal, which is about 6%.
Exactly.
So for a $100,000 investment, right now, I think we were looking on your website today for a $100,000 investment, you were getting $9,501 a month for 10 years. The annualized distribution is $11,000. So you're getting a roughly in the 10% to 11% range right now. So it's easy to understand. If I buy this right now, I'm going to get $9,501 for the next 10 years. And the bottom line, though, is after 10 years, all the money's distributed, right?
Correct.
People need to understand that you're taking the principal at the time. And what's interesting here is you can buy and sell this at any time, right?
Correct.
You might get a different amount of distribution every month, depending on the price, but you can buy it at any time.
Exactly.
And what happens when interest rates change? This is the important thing. You're locked in, right? You know, because you're holding these to maturity, right?
Exactly. The mindset is you're buying today, you're locking in interest rates all the way through that end year. So if you buy LDDR, you're
Right.
locking in cash flow for the next
So
decade.
that 9501 a month is not going to change for 10 years, right?
Correct.
Okay. Now, of course, the risk here, Dave, of course, is we get inflation, and this becomes, that $9,501 becomes a little less valuable.
No,
What do you do
nothing
then?
here is nothing's really protecting your buying power here. They do have an inflation protected version of this, but there is no way to guarantee that if we have 10% hyperinflation, that anything is going to necessarily keep perfect track with that. This is a fantastic tool for immunizing liability. If you know that you've got certain payments that you're going to have to make, say like a mortgage on a second property or college payments that you're trying to make, this is a great way to take that cash flow and put it out of mind so that you know it's covered. I think this is a great psychological tool for a lot of investors. It's much easier to let something ride when you know it's going to pay out in the end.
Yeah. This is a good time to bring up tips because there is an inflation-protected version of this as well. Obviously, you get a different payout on that. So if you're going to pay to have inflation protection, the payout's not going to be as much, right?
That's exactly right. So it'll start lower, and then if inflation is as expected or higher than expected, it'll certainly be more over time. And under the hood, it's effectively the same product, but we buy inflation-protected government bonds instead of regular bonds. Charge the same fee. We're just creating a different bond ladder for you to solve a different problem for you.
So, and here's the full screen here. The advantage of having your cash one here is you get more money now. And with the tips, that's Treasury inflation protected securities tips. Inflation protection becomes more important long term.
Exactly.
I mean, if you're doing it for 20 years, you might want to get some inflation protection.
That's exactly right.
You're basically
longer
trying
the
to decide,
horizon.
what do I want here? If I just buy this for 10 years, do I not care about inflation? I just want to know I get $9,500 a month. That's what I care about. I'll take the inflation risk. Or you can get less money and buy inflation protection too.
Exactly right. And you have both choices available to you.
Yeah. But why government bonds? And it's all treasuries here, right? You're not buying corporates or munis. Why just treasuries?
So the idea here is all about helping people create financial security. And when you look at how things are going this week, it's a volatile time in the market, stocks and bonds, and it's a rough time to be in corporate bonds. It's a rough time to be in munis. And if this product is there to create financial security for you at a time like this, knowing that it's treasuries and that you're in the bond that is least likely to default on you, I think is really important to maintain peace of mind in the really tough times.
Yeah.
That's what this is about.
Now, let me ask you about the tax treatment, because this gets very important to a lot of our viewers who are older here. When I pay taxes, I'm paying taxes just on the dividend, right? Not on the principal, is that right?
Correct.
You tell me.
Exactly. So, of course, this is only relevant to the taxable account, not your
taxable
401k or
account.
IRA. You're going to pay tax on the treasury interest component, which is about 4% a year of taxable income right now. You're not going to pay tax on the principal. That's part of what's so powerful, because the fact that we're distributing you principal along the way means more post-tax spending power along the way.
Yeah.
And lets you keep your other assets invested.
And you know, Dave, I don't know if you have any thoughts. I know you're not a tax advisor, but this kind of account, would it matter at all to be, if you were in a 401k, you know, tax protected account, or you were in a taxable account? Would that matter at all?
In general, you're sort of wasting the tax benefit of the return of capital kind of contribution, which I've been writing a bunch about how return of capital can actually be a helpful tax hack. In this case, you are genuinely just getting your principal back. In between when you buy it and when you sell it, you'll be writing your basis down until it gets very close to zero, until at some point you literally don't have anything left because everything has been distributed.
Right.
So
So
in
is
some
it better
ways,
to be in a 401k or a taxable account? What's the simple answer?
I think this is way better in a taxable account because you're getting the maximum advantage out of either the tips themselves, if you're going that route, and out of that return of capital way of deferring spending or spending down your own savings. So I think this makes more sense in a taxable account. And I think it's a great way for folks who maybe not even think about retirement long-term goals, but just want to capitalize, say, on a spike in interest rates. I mean, we see the 10-year cross 5%. People are going to ask, well, how do I take advantage of it? At this point, you're going to be able to buy a product like this, which will lock in the implied payment from a spike in interest rates like that.
Would you agree with that? I know you guys aren't tax accountants,
Yeah.
but would you agree with that general idea, better in a taxable
More
account?
tax efficiency in a taxable account, that's for sure. If you do have most of your assets in a 401k or an IRA, you can use it there, and it's a really nice way to help have cash flow to meet RMDs, make your life really easy when that time comes.
Not to be morbid, but what if I die before I get old? No, I'm sorry, that's a Who song. I don't mean that. What if I die before the term is over? Does that...
It's just an ETF, so the ETF is going to pass right to the estate to whatever the beneficiary
So
is.
unlike an annuity, right? If you die, you lose it, right?
Exactly.
Here, if I die, it goes to my estate.
Exactly.
Right.
The simplest way to think about what we've done, in some ways this is just a treasury ETF. That's where the return comes from. It behaves in all those same ways. The magic is in the way we pick the bonds so that you get the cash flow out safely through maturities instead of through selling and taking the market risk that we're seeing really play out this week.
Yeah. And Dave, as you noted,
Bob,
go ahead.
there's a benefit if you die. Aside, I mean, it's not great for you, but for your heirs, because this is going to distribute return of capital month after month. If your heirs end up inheriting it, all of that gets wiped out and the basis gets reset. So you never end up having to worry about taxes on that component.
Yeah. But you're right. Dying would not be good for me. That's a brilliant observation there, Dave. Thank you. There's a reason I have you, Dave, around to point out these things to me. That helps. Dave, you're sort of the overall guru for ETFs. I often go to you about this. This seems like a great product. Is there anything that raises any red flags to you about this? I mean, people should know that we haven't covered already in your mind.
Yeah, I mean, the main thing is you need to understand that when things happen like what's going on in the market right now, where we have the bond market sell off, the net asset value of these is going to come down. And that's going to be a shocker. You're going to be, wait, my bond fund that's supposed to be stable is down a few percent. That's completely normal. You shouldn't care because the whole point of this is holding it to completion, holding it to maturity. So this isn't a product to be day traded. This isn't a product to be worried about the NAV. They're, to be blunt, very boring in construction. And I'm a big fan of boring when it's delivering an actual pattern of returns that investors need, which this one is.
Boring is good. I mean, you follow, I don't know if you follow ETFs like Dave and I do, but it's been dizzying the amount of new ETFs this year and some of the strange flavors they've been coming in. I always say, you got to be able to explain it to your mother. One of the reasons I like this product is I could explain it to my mother. Okay, Mom, you give me $100,000, you get $9,500 a month for the next 10 years. My mother understands that. And that's one of the things that I like about it.